Michael Burry is the subject of The Big Short, an award-winning book and film about his bet against the housing market as the 2008 financial crisis loomed. Today, Burry remains an active investor and continues to run his hedge fund, Scion Management. With talk of another major market crash, Burry has been in the news a lot lately, and he has thoughts to share with investors. In this video, we'll take a closer look at Michael Burry's history and share 8 pieces of Michael Burry investment advice every investor should know. Let's dive in. 1. Do your homework. The first thing Burry tells investors is that the key to success in investing is to put in the work. Analyze, think independently, be informed, find the data, and you'll know a lot that no one else does, he told followers in a tweet. 2. Look for demand. Burry is a fundamental investor, and one of his favorite ways to find companies on markets worth investing is to look for demand. Everywhere you see shortages, things, people, places, experiences, and services. You know the price is just not high enough yet, Burry tweeted. That's been especially relevant in the aftermath of the COVID-19 pandemic, when there are shortages all across the US consumer economy. According to Burry's thinking, these shortages are a sign that prices and profits have room to rise. 3. Think about the long term. While many famous investors encourage long-term thinking, Michael Burry takes this to an extreme. In 2020, he said that the COVID-19 pandemic was a temporary problem that wouldn't affect the long-term value of the companies he invested in. If you have an investment time frame of 10 years or longer, it's worth thinking about which trends and events will really impact your investments and which are just temporary buying opportunities. 4. Be confident in your investments. The most impressive thing about Michael Burry's bet against the housing market isn't that he was correct, rather is that he was able to hold his course for more than 2 years, even as his investors began to revolt against him. "We had a giant bet for us," Burry said about his short position, "and I was extremely confident in the outcome. I know for sure that some investors thought I lost my mind." Ultimately, of course, Burry's confidence led to a $700 million payoff for those same investors who questioned why he was holding his position. 5. Dive into financial statements. Burry's style of investment involves careful analysis of not just what a company's potential is, but also how it makes money. Burry told one investor who asked for advice that he tears through 10Ks to understand the subtle differences between companies. He also recommends reading Financial Shenanigans: How to Detect Accounting Gimmicks and Fraud in Financial Reports by Howard Shillett to learn how to identify questionable accounting practices. 6. Don't get drawn in by hype. Burry has been one of the louder critics of the recent jump in meme stocks and crypto. His firm, Scion Management, has a large short position in Tesla and tweeted that hype about Bitcoin is drawing in retail traders before the mother of all crashes. To Burry, this is the same kind of hype that led to the housing bubble in the mid-2000s. The result wasn't good for everyday investors then, and he believes that the result won't be good for those who invest in speculative stocks today. 7. Watch out for borrowed money. Along the same lines, Burry warns investors they should be on the lookout for borrowed money. Borrowed money results in a bubble of the housing market, and Burry sees the same type of leverage-induced bubble forming in the crypto market. Without knowing how much debt is underlying Bitcoin and other digital currencies, says Burry, it's simply not safe to put your money in those assets. 8. Look for unpopular companies. Another thing Burry tells investors is to focus on companies that are taking a beating from Wall Street. "I try to buy shares of unpopular companies when they look like roadkill," Burry says, "and sell them when they've been polished up a bit." If this advice sounds familiar to something Warren Buffett might say, that's because it is. Burry points to Benjamin Graham's 1949 book, The Intelligent Investor, as his guiding star, and Buffett studied under Graham before starting out investing on his own. Ultimately, what matters in investing isn't being right 100% of the time, it's making money. And to do that, you have to be willing to admit your mistakes when they happen and move on.